How does a market surge of 93% sound to you? Well, that's exactly what's happening in Dubai's commercial real estate market as it hits a staggering $8.44 billion. Welcome to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. Let's get right to it. In the second quarter of 2025, Dubai's office market witnessed a remarkable 93% increase in sales compared to the previous year. The total transaction value reached 31 billion AED, equivalent to $8.44 billion. This represents a 50% increase from the previous year, according to a report by CRC Property. The report highlights a decisive return of investor confidence, driven by the launch of high-quality off-plan commercial developments and a rising demand for Grade A office and industrial assets. A total of 965 office units were sold in the second quarter of 2025, up from 764 units sold in the second quarter of 2024, reflecting a 26% increase in transaction volume. Business Bay and Jumeirah Lake Towers continue to dominate activity in the office market, but emerging zones like Motor City and Barsha Heights are also gaining traction. These decentralized locations offer flexible layouts and competitive pricing, making them attractive to both investors and end users. The report also notes a significant shift towards off-plan office sales, with projects like Omniat's Lumina Tower setting new benchmarks in workspace design and amenities. This trend reflects a maturing buyer mindset, as both long-term occupiers and institutional investors commit to spaces that meet future needs. Looking ahead, Dubai's office market is expected to see a steady influx of new supply, with 680,000 square meters anticipated to be delivered across the city by 2027. Key areas like Business Bay, Motor City, Marjan, and Dubai Land are set to benefit from this upcoming stock, aligning with rising demand in recent quarters. The average selling price for secondary office sales in Dubai has shown significant growth, rising to 1,724 AED per square foot in 2025, a 22% increase from the previous year. This increase is driven by heightened demand for established office properties and limited new supply. On the leasing front, CRC reported a 30% increase in deals quarter on quarter, with the average leasing price for offices nearly doubling year on year. This growth is attributed to increased demand for larger, fitted, and strategically located office spaces as businesses seek to upgrade their premises in a competitive environment. The retail segment also saw growth, with average leasing prices rising 7% year on year. This reflects stable interest in community and high-footfall retail spaces, where tenants are willing to pay a premium for visibility and location, particularly in emerging residential areas. Meanwhile, the warehouse sector experienced the highest average leasing price at 1.26 million AED, with a 95% year-on-year increase. This rise is fueled by sustained demand from the logistics, manufacturing, and e-commerce sectors, combined with limited supply of large, high-specification warehouse facilities. San Antonio is set for explosive retail growth in 2025, according to a report by Melanie Salazar from MySA. Several major retail projects are coming to fruition, providing new shopping opportunities for residents. Despite challenges like inflation and tariff increases, developers are pushing forward with construction in various neighborhoods. Bath & Body Works has opened a new location at Westover Marketplace on San Antonio's far west side. This store features a design aimed at attracting Generation Z shoppers, with a spacious floor plan and interactive product testing options. Burlington has expanded its presence in San Antonio with 3 new locations, increasing its total in Texas to 126. These new stores are located at Crosstown Mercado, Brooks Corner, and Bandera Road, offering budget-friendly shopping options. Dollar Tree is constructing a new store at the Park North Shopping Center, expected to be completed by October 2025. This addition raises hopes for more savings opportunities for customers, particularly during the Halloween shopping season. Marshalls and Sierra Trading Post are set to open at the Rim Shopping Center, with construction costs totaling $1.5 million and $4 million, respectively. These stores are anticipated to open between July and September of this year, replacing a former Market by Macy's location. A new thrift boutique, Shop My Closet, has opened on Bandera Road, offering gently used fashion pieces that reflect current trends. This women's-only boutique is operated by 28-year-old entrepreneur Miriam Carrizales. San Antonio-based developer Birnbaum Property Company is developing Borgfeld Crossing on the city's far north side. This new plaza will feature Mexican cuisine options, beauty shops, and medical and dental businesses. Cottonwood Point Retail Center on San Antonio's far west side is nearing completion. The center is seeking quick-service restaurants, coffee shops, and Pilates studios to lease space, enhancing the retail landscape. In the Stone Oak area, investors are pouring over $11 million into two new retail developments, Providence on the Green and Stone Oak Mercantile. These projects are set to include popular spots like Chick-fil-A and Black Rock Coffee. The Shops at Babcock, located near the Country View Village and Tanglewood neighborhoods, is set to host a pizza restaurant, coffee shop, and martial arts school. This center plans to open its doors this summer. Castroville, a small town west of San Antonio, is preparing for its first bustling shopping district, Alsatian Oaks, which will include stores like TJ Maxx and James Avery. Phase 1 is expected to be completed by next summer. Potranco Reed Ranch South Retail is a new development that will feature a Dollar Tree, as is Brick Oven and Grill, and a McDonald's, among other businesses. This 44,000 square foot center is set to enhance the local retail scene. The Portico at Shanefield Ranch, a $20 million retail development, is nearing completion. Tenants such as Box Street Social, Black Swan Yoga, and The Fish House will soon begin building out their spaces, contributing to San Antonio's retail growth. A massive shopping center is under construction at Talley Road and Wiseman Boulevard, with several restaurants like Fat Burger and Round Table Pizza expected to open. This development by Birnbaum Property Company is slated for completion by spring 2026. Outdoor shopping malls have seen a consistent rise in popularity over the last decade, a trend further solidified by the aftermath of the COVID-19 pandemic. As people began to venture out again, many opted for open spaces, giving outdoor malls an upper hand in recovery compared to indoor malls. The inherent appeal of outdoor retail, especially in a climate like Los Angeles, sets these centers up for success, though not guaranteed. According to Megan Martindale, a retail professional at Avison Young, outdated shopping centers lacking modern relevant tenants in retail, experiential and dining segments can face challenges. It's not just about driving foot traffic and visits. It's also about building that loyalty and that frequency, Martindale emphasized, particularly in a competitive market like Los Angeles. Martindale identifies two types of outdoor retail: centers with one owner, executing a unified vision, and organic street environments. Each has its strengths. The first category offers an immersive, curated atmosphere, exemplified by developers like Caruso and Westfield Group. Caruso, known for the Grove LA and the Americana at Brand, has the advantage in curating experiences tailored to Los Angeles, maintaining 100% occupancy. Westfield, despite its corporate structure, stays current with local consumer preferences, offering experiences like the Minecraft movie experience at Century City. Street-oriented retail spaces like Abbot Kinney Boulevard in Venice maintain appeal through a cool factor, attracting niche and international brands while keeping vacancy rates low. In contrast, areas like 3rd Street Promenade in Santa Monica have seen a decline, with a 21.4% vacancy rate. Martindale suggests reimagining incentives for retailers and consumers, potentially offering discounted rents to attract tenants. It's better than a vacancy for 3 years, she noted, emphasizing the importance of pricing real estate right to draw retailers back in. Indoor malls face challenges in maintaining relevance, particularly in Los Angeles, where outdoor options are preferred. The traditional indoor mall formula, department store anchors, quick food options, and movie theaters, is no longer sufficient. The shift in consumer habits has increased interest in smaller, local boutiques and experiential tenants. Successful indoor malls like the Beverly Center have reinvented themselves through extensive renovations, incorporating aesthetic and entertainment upgrades, and aligning more with the bright atmosphere of outdoor centers. Grocery-anchored retail centers have remained resilient, maintaining high occupancy rates between 95 to 97% from 2020 to 2025. Jim Dillevue of Paragon Commercial Group attributes this to the distinction between necessity, and non-necessity retail, reinforced by the pandemic. Grocery sales increased, proving the durability of necessity-type tenants. The rise of click-and-collect models, where consumers order online and pick up in-store, has influenced the design of grocery centers, with more temporary parking spots and less physical store space required. Specialty grocers, such as Sprouts Farmers Market and Trader Joe's, have contributed to changing spatial needs in grocery stores. These grocers attract diverse customer bases and higher rents for grocery-anchored centers, while also fitting into the community fabric. Deliveroo emphasizes the importance of local merchandising, tailoring stores to the demographics of each area. The success of grocery-anchored centers is tied to their ability to integrate with community needs and preferences, making them valuable assets in the retail landscape. McDonald's Corporation is seizing headlines with its decision to sell 8 retail properties in Hong Kong, valued at an estimated 1.2 billion Hong Kong dollars, which translates to 153 million United States dollars. This move provides investors with a rare chance to own fully tenanted assets, as McDonald's reviews its real estate portfolio in the region. The Chicago-based fast food giant has appointed JLL as the sole agent to facilitate the sale of its assets in key locations such as Tsim Sha Tsui, Causeway Bay, Mong Kok, Kennedy Town, Tai Kok Tsui, Yuen Long, Tsuen Wan, and Tsuan Shan. The public tender is set to close on September 16th, offering a limited window for interested parties to submit their bids. Despite the sale, McDonald's intends to continue operating its restaurants in these 8 locations under long-term lease agreements. Some of the properties will also include additional tenancies with 7-Eleven convenience stores and independent pharmacies, enhancing the appeal of these assets with diverse and resilient tenants. Eunice Tang, the executive director of capital markets at JLL in Hong Kong, highlighted this as an exceptional opportunity, emphasizing the quality of these retail assets backed by stable, long-term tenants like McDonald's. The portfolio boasts a 100% occupancy rate, offering investors stable income and a high rental yield. According to JLL, there has been significant interest from a broad range of potential investors, reflecting the attractiveness of acquiring such high-quality retail assets with long-standing, reliable tenants. This sale marks a notable moment in the Hong Kong real estate market, providing a rare chance for investors to secure stable, income-generating properties. In 2025, Romania's commercial real estate investment market is set to continue its recovery, buoyed by lower inflation and renewed investor confidence, especially within the office, industrial, and retail sectors, as per consultants' analysis. The investment volume in the first half of 2025 reached approximately 300 million euros, with transactions exceeding 500 million euros currently in negotiation stages, according to data from Cushman & Wakefield Economics. Vlad Savtoiu, head of research at Cushman & Wakefield Economics, noted increased activity in Bucharest's office assets, attracting 2 new investors to Romania in the first half of the year. Despite pandemic-era disruptions, prime office assets in Bucharest are experiencing decreased vacancy and rising rents, which are favorable conditions that may attract more capital in the near future. Yannick Van de Pare, country manager at Speedwell, predicts a significant rebound this year, with investment volumes potentially surpassing 1 billion euros. The office and industrial sectors are expected to lead, particularly projects with strong environmental, social, and governance credentials. Retail is also gaining ground, especially when integrated into mixed-use schemes. The retail segment began the year strongly, highlighted by a single investor from the United Kingdom, MCOR, purchasing Suceava Shopping City and a portfolio of 7 retail parks for a cumulative value of 105 million euros. The year 2025 holds potential to be a record year for industrial investment deals, contingent upon the planned takeover of P3 by CTP, pending approval from the Romanian Competition Council. Silviu Pop, Director of Central and Eastern Europe and Romania Research at Colliers, suggests that investment volumes could reach 800 million euros, with the possibility of hitting 1 billion euros if conditions align favorably. In the first quarter of 2025, total investment volumes across Central and Eastern Europe grew by 143% year-over-year, following a 70% increase in 2024. Czechia led the way, attracting 1.5 billion euros in investments, 4 times the amount recorded during the same period last year. Despite this, Romania posted an 8% decline, according to a Collier's report. Investors in Romania remain focused on retail parks and shopping centers, emphasizing the importance of physical locations for customer experience and brand visibility, even as e-commerce continues to rise. Class A office buildings in central areas are also in demand, particularly from growing industries like information technology, with new projects emphasizing quality and sustainability poised for success. Challenges such as high construction costs and limited financing sources persist, yet developers find opportunities in modernizing older buildings and expanding logistics hubs. Stability in interest rates, consistent fiscal policy, and European Union green transition funding deployment are pivotal elements shaping property investments this year. Geopolitical instability is a major concern for the real estate industry, with rising global uncertainty surrounding United States trade policy. Although the United States is not the primary export partner for most Central and Eastern Europe countries, indirect exposure remains a risk, particularly for Slovakia and Hungary. Moderate tariffs, like the 10% imposed on European Union exports to the United States, could harm trade, especially in the automotive sector. In the broader European context, real estate yields have peaked in Western Europe, with the European Central Bank key rate decreasing over the past year. This trend is expected to further boost the appeal of real estate deals over the medium term. Additionally, local capital is increasingly targeting real estate investments, with Romania experiencing significant economic growth over the last 2 decades, leading to successful local businesses looking to invest excess capital in real estate. Iulius, one of Romania's largest domestic investors, is developing large-scale mixed-use schemes across the country. Their projects in Cluj-Napoca, Iasi, and Constanta include urban regeneration initiatives with substantial investment budgets. Rivas Cluj-Napoca, currently in the final building permitting phase, represents an investment of over €550 million, aiming to integrate the largest retail area in Romania. In Constanta, Iulius is preparing for the most extensive reconversion and urban revitalization project in Romania, set on a 38-hectare land plot with an investment budget of around €800 million. Iulius is also investing €28 million in a convenience retail project in Iasi and has started upgrading its Palace urban complex. The Alpen Group, a local hospitality player, has allocated a €10 million investment budget for its hotel business, closely tying its performance to Romania's economic health and consumer spending power. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.